Good evening, guys. This is Santiago from Moat Investing. It's a pleasure for me to stay this night with all of you, and I'm going to talk about Moat. The ticker is MWK. What Moat is about? So Moat is basically an e-commerce company. Probably describing this company as an e-commerce one is a bit reductive because Moat is really disrupting the traditional e-commerce, in particular the brick and mortar e-commerce. So they are basically driving a shift from, let's say, business to consumer to data to consumer. At Moat, data analysis is used to support all those tasks, such as product selection, pricing product, taking a buying decision on what product they have to add, let's say, tracking also the return on investment and other function. So Moat is relying on a software platform and developed in-house called IME, so AIMEE. This company basically represents the real competitive advantage of Moat as compared to other traditional e-commerce. According to the management, so this competitive advantage would stretch over some years ahead. We don't know whether this is concrete or not, but we guess Moat over time is going to build a sustainable moat going forward. So they are going to defend and to consolidate their competitive advantage. We have written a piece of research which you can find on Seeking Alpha, where you can go deeper into all the details of Moat, what they can do through their proprietary software, and why they will reap the benefits of these new e-commerce trends over the long run. But what is important basically to highlight today is how we get across a Moat valuation and to which extent Moat has still an upside potential. Our valuation approach has been based on revenue and EBITDA forecast, basically available on Bloomberg. So these are consensus data. We have seen what the market and what analysts are factoring in terms of revenues from over the next 9 years, from 2021 to 2030, the revenues are expected to grow at a compound annual growth rate of almost 16%, while EBITDA margin is going from 5.3% expected in 2021 to 15.3%. We have to say that basically Moat, despite all growth stories, is already cash positive. So they have a positive EBITDA, they have a positive working capital, let's say, change in working capital contribution to cash flows, because thanks to IME platform, they are able to efficiently manage the inventory in particular. And they also have a limited capex for the time being, because most of their capex are dedicated and committed to continue developing the algorithm behind IME. Bearing this in mind, we have assumed that the EBITDA is going to be converted into free cash flow to the equity, so that's available to shareholders in a percentage of 60%. By doing so, we have figured out what are the free cash flow to equity expected over the next 9 years. And then we have discounted this cash flow at the 9% cost of equity. So our discount rate is 9%. We came across assuming also a G of 3%, we came across to a terminal value, and we finally find out our base case target price, which is $49 per share. This is what we call the base case, and we believe it's conservative for two main reasons. Number one, because probably the 15.9%, so almost 16% compound annual growth rate in revenues might be underestimated. Because this company is rather new, so there's still a sort of learning curve in trying to understand what is a sustainable growth in the long term for Moat. So our idea, despite we have used consensus data, our idea is that this compound annual growth rate might be underestimated because they are extremely efficient in deploying capital to grow via M&A. So this means that they will continue doing that. And the pipeline is quite robust because there are a number of, potential targets. And on top of that, we should consider that Mohawk is not only interested in getting across an entire category of product. They might also simply cherry picking a simple product they are interested in. And they are extremely fast in integrating this chosen product within their network, within their catalog. And that's the real point of strength of their strategy. So compound annual growth rate might be underestimated by the market. But anyway, we have relied on this data because we want to see how the stock is worth assuming those consensus data. On top of that, we have converted the EBITDA into free cash flow at 60%, which might be itself underestimated. Why? Because basically having an efficient working capital management and having also a limited capex, so their capacity to generate free cash flow might be far higher than 60%. So to this extent, we have made a sensitivity analysis, which we believe is the most intriguing part of the valuation story. And we have seen how the target price, so the equity value, changed whether we change our value drivers, which are basically 5. So the growth in revenues, the EBITDA margin, the conversion of EBITDA into free cash flow, the discount rate, and the perpetual growth rate. What is intriguing to see is that probably the most important data to the extent of valuation is the growth in revenues. So each 1% increase in the compound annual growth rate from 2021 to 2030 commands 3.5 euros per share increase in the target price. While, let's say, 1% increase in the free cash flow conversion commands 0.5 increase in our target price. So the magnitude is 1 to 10. And this gives an idea of what is the potential share price appreciation once they beat market estimates. We should consider that in 2021, they've already upward revised growth estimates because they made an acquisition, which was basically fully integrated. So this is really what we have focused on and what the market should focus on. We believe that the equity story and why they are basically changing and disrupting the traditional market is an information fully available. You can rely on our Seeking Alpha article, and you can see how deeply we have digged into this issue. But anyway, when it comes to the valuation, here is where we believe we are capable to deliver more value added because we rely on our proprietary valuation model, which takes into consideration those 5 parameters. To conclude, we believe that despite stock appreciation we have seen over the last couple of weeks, there's still potential upside because the pipeline of potential deals is still reduced. And I repeat, probably consensus is still underestimated for a number of reasons, the revenue growth potential of this company. That's all for the time being, and we will be glad to address any question you may have. Thank you for your time, and stay tuned. And don't forget to put a like.